People, good to be back again. Rajeev here, managing partner at Arise Venture Partners, an early stage VC fund with close to 100 startups and multiple unicorns. As we wait for something productive to come out of Biden and McCarthy's conversations, and I'm paraphrasing somebody here, we are headed towards a big week for macros with anticipated data releases for inflation, retail sales, industrial production, and much more. To understand how these things will impact the markets, we have invited a guru and an expert, Nadine Terman, founder and CEO of Solstein Capital. Solstein is a San Francisco-based investment firm, a lovely city. So, Nadine, I've been there multiple times, it partners with institutional family offices and HNW, high net worth clients, to construct tactical global portfolios across asset classes. Nadine herself has got 25 years experience across public markets and private equity. Prior to founding Solstein Capital, she was a partner with Bloom Capital and served on its investment committee. Her career also spans investment positions with Berman Capital, Merrill Lynch, and Goldman Sachs. She's a regular contributor across global television, radio, and media platforms, including CNBC's Fast Money. She is also a co-founder of Longbow, which is a data-driven stock trading risk management dashboard designed to help traders make more informed trading decisions. I think it's going to be quite exciting for us, to hear from Nadine today. I'm going to request Nadine to take center stage for about 20-30 minutes, where she will explain to us the framework that she has in mind. And after this, we'll move to a short Q&A. And I look forward to a productive 45 to 60 minutes. So Nadine, without further ado, over to you.
Sure. I'm going to share my screen because I think it might be a little bit easier. So if people want to, look at things, take a picture of the screen. I always find it easier myself when I'm watching people. But thank you so much, Rajeev, for having me here. I'm happy to connect with folks all over the world, something I love to do because I always find feedback and insights from other people to be, very helpful in our investment process. And just a little bit on that before I get some of the good meaty stuff that I think people are more interested in is just to get to a little bit know what we do is we try to be non-consensus because the asymmetry is usually in your favor, because if you're wrong, everybody's already on the opposite side of the trade versus where you are. But then if you are right, then they have to move their capital over to your side. We also try to be high conviction. That doesn't mean concentrated positions. It means conviction investment themes. So we tend to have 8 to 15 investment themes that could be around, transition to the cloud, people obviously buzzword AI, it could be energy transitions, things like that, and then multiple positions within there. And we try to focus on quality. I'm not going to give you all the stats, but we've done a big back test of our framework. And basically, quality businesses do better in all types of environments. So it's not the MSCI definition of quality, but it's our definition of quality. It's what you would expect from, shareholder-oriented, good management teams, cash flow, putting it to good work, to good use for ROIs, ROEs, those types of things that have moats around their business. And then tactical. And this is where I think the meat of the conversation today should be spent, which is changing economic and macro environments benefit flexible mandates. Just like you saw last year, there's times when you should not be long bonds in tech, right? You're having the same overlapping concentrated exposures and drivers of your portfolio. So we really start with a 3-step process, which I'll quickly run to. So before I get to some of the meaty data, but you need to be tactical to know where is the world headed macroeconomically and then market-wise so that you can shift your portfolio a little bit ahead of time so that you're ready for those moves. And then manage risks. This is something that we have to do differently for different kinds of clients. We try to figure out what are the risks we want to take, and let's make sure that we understand them. And the things we don't want to take, if we can, we try to hedge them out. And if we can't, just make sure they're small enough or understand that maybe we can't do certain kinds of positions because the risks are too large. We try to have a longer horizon. It doesn't mean that you shouldn't be tactically around trading positions. What it means is you try to see through to where things are headed so you can build your position ahead of time. So the first thing, mapping the environment, what we use is macroeconomic data to say, where is the world headed? You want to be aligning your portfolios over time to where things are going. Number 2 is identifying opportunities. I'll explain this a little bit more, but finding those quality businesses, right? And then 3 is managing the positions tactically. So knowing when something's overbought or oversold, and I'll give you a look at our Longbow platform and show you a few things that are flagging today. but you know, how do you know when to be buying the position you want to buy? Or how do you know when maybe you got lucky and it's overbought and you need to trim or sell a little bit? You know, how do you know when to put on hedges? This is where, well, it's a very data-driven process. So the market's going to tell you those things versus the fundamental process, which is what do you want to own when? So if we look at, you know, why do we have that the top-down approach? Is you really want to say, okay, when growth of GDP is accelerating and inflation's going down, right? The growth of inflation is decelerating. You're going to have a pretty neutral policy, and this tends to have the best equity returns. This is when you're, you know, going to be having cyclicals. This is when you're going to go higher beta. We'll go into the playbook a little bit more in a second. But reflation, when growth is accelerating and inflation is as well. So out of, you know, the pandemic, obviously this was happening. So policy gets really hawkish, rates are rising there. Inflation is when growth is going down, but inflation is accelerating. So obviously we were in a period for a while here where this was happening, but right now we're having like a high and sticky inflation. So while it's not acceleration, it's decelerating, the growth is, you're kind of stuck here between deflation and inflation, where eventually we're headed here, which tends to have actually the best returns for the US dollar, but pretty poor returns across asset classes. So policy becomes a lot more dovish. So obviously people have been pricing in heading to being dovish here in the US, but we'd argue that we're still kind of stuck in this inflation area. And what we show you here is that there's a back-tested approach to this data-wise to say in each of these different categories, you know, each of these different macroeconomic setups, what should you be owning? You know, is it fixed income in the dollar versus equities and commodities? Should you be in the safe, you know, long duration assets like staples, utilities, REITs, versus, you know, energy or other areas? What's the style that you need to be in? And this isn't just in the US, but this is back tested across the world. So we have individual returns for these things per country and then across regions, and then fixed income, where do you play, right? And currency and materials. So I'll show you where the projections are today, because I think that's the most interesting to say, well, what is the data saying? And you don't have to read all the different letters. We try to do a village idiot approach here of what are the colors. And so you're moving, right, into a lot of blue, which is deflation. So if you remember, that's when the growth of GDP, inflation are decelerating. So inflation's kind of still high and sticky. So you're kind of still like seeing some reds here. We've seen through the first part of the year, it felt like Goldilocks, tech was doing really well, right? But we're heading into an area where there's a slowdown before you get towards maybe the end of the year in certain areas that could improve. And you know, we have the percentage probability of each of these projections per area. So that's the first thing, is you want to identify where you're headed in your playbook. And I'll get to what is our playbook overall in a second. But the second part of our process, which I think important to understand, is how do you pick out what to invest in? I think now it matters more than ever, right? Is you want to be picking out really high quality businesses. And that is at an absolute level and a relative to peers, lower debt to EBITDA. The structure, you know, hopefully it's shareholder oriented and gives them flexibility. Like some REITs have to have a certain amount of payoff that can be less flexible. Geographies, you actually, you know, what is the exposure for us, at least dollar-based or non-dollar based? What is the risk around that? The level of cyclicality. Obviously, you don't want super cyclical things right now if you're going to be having pressure on the growth. Not a lot of concentration. You want, obviously, a lot of the money flowing to the bottom line. If you have a high fixed cost structure, that can be difficult when growth slows. Barriers to entry, you want that to be lowered. You want to have some sort of barrier, whether it's through a cost position, a technological advantage. You don't want a very intense competition situation. Regulation can be a positive reminder, because that can often be an open the envelope type risk. We want high returns, high growth drivers, and then obviously liquid. And then from the value factor, you know, we're looking at what are the expected returns, the asymmetry. We'd rather have call it, if you like baseball, singles and doubles versus always shooting for those home runs, because those tend to be a bit more risky. And we want the sources of returns coming from growth, less from financial engineering, although that can be controlled, Cost reductions also can be more manageable because you know that they can take them out. Multiple expansion is not something that we like to bank on. And then valuation multiples. So this is how we define quality and value. And we're trying to, if you look at a portfolio here, be trying to get really high quality businesses, going out to the right, and then having better value, so going up the chain. So we want to be making these positions larger, and then the ones around here called satellite positions can be a bit smaller. But I think more interesting for you, and getting to some of the points that you talked about before, and this is where Longbow comes in, is the data tools around where is everybody else positioned, where is the money flowing. That's very important to know, because fundamentally you might think you have the best thesis in the world, but the security might be not trading as you expect it to be. So you need to be looking at the more technical signals. And that's really something that we learned over time. Since more than 70% of trades are done by computers, not humans, they're looking at the technicals. So you are forced to look at what they're looking at to make sure that your thesis is going to play out. And that gets to me to the macro and the overall setup, which we'll come to. But I'm going to show you in the interim here, the Longbow dashboard, which, you talked a little bit about the Doomsday Dozen, but I'm going to head first of like why this matters. You want to be looking like, let's say I'm going to look at India. I think it might be interesting for you guys. This is INDA, one of our ETFs that trades here in the US. It's sitting there neutral. So I'll pick something else that's overbought and oversold in a second. But you can see over time how our algorithms expect it to trade by price and volatility. And you can see it's in the middle ends of the trading range. So this is something where you might be sticking with India. We're long India. I'll let you know through individual locally priced positions. But you can also, as we do in some accounts that can't buy local shares, for us, buy an ETF like the INDA. But this is when you don't do anything. But it has an okay setup. It's neutral on the short term. So if I look, it's kind of neutral where it's been trading, but it's been bullish on the medium term. So it's been up and to the right. And I'm looking at some of the stats. How do I read this? It's got a very high correlation to the US markets, the S&P. So you obviously need to be a little bit careful about what's happening in our economy. We can talk about the debt ceiling. Doesn't come with short interest and all, but the signals here that we're showing are low. It does have a pretty high implied volatility premium. So people are paying a ton for protection on this security. So people are, saying, I got to protect this security. So that tends to, if things go well, like actually move the security up, right? Because if everyone's betting against something, again, you want to be taking the opposite side of the trade. So if this were to fall at the low end of the trading range today, which is 40.43, that's something that maybe you'd want to buy into. Right now, though, it has a little bit more odds to the downside because it's a little bit above the median. So you're like minus 1.7 to 1 odds. But we use these type of signals to say, where are the options markets pricing this? How is it trading? Short term, medium term. There's a lot of other things here, the momentum indicators and things that we're talking about. And there's a lot of education on this site. We look to this to then say, like, okay, if we have Indian positions in India, like, how are we thinking about how the market is trading and versus other things? And so it's a neutral overall right now, but we can see that the EFA, so that's developed ex-US, is oversold. So, and it's actually flagging a long position with not a huge signal strength. So this is something, if you were trying to go long, like call it Europe, Japan, Australia, and the like, this is something you could think of. Or the overbought VIX. Here in the US, people are overpaying for volatility right now. People are worried. And the dollar is nearing the top end of its range. That tends to happen when people are looking for security, right? And again, we can kind of go into that, but you mentioned the Doomsday Dozen. And one of the things, again, we look at for technical signals to really understand, what are the overall risks? What are other people thinking? I think this helps give you a temperature, is that when people are extremely greedy, so that's our, dashboard of 100, you really got to be careful because everybody's on one side of the trade. But if everybody's, call it during the banking crisis or, March of 2020, very, very fearful, it can give you more conviction of entering some of your riskier trades or risk on trades. Right now, we're sitting in the 70s, so you can see that it's, a lighter red, so it's not, 80 to 100, but what it means through all of the different signals under it is that you should probably have a little bit of risk management going on, because people have gotten a bit greedy through this big, tech run up, Japan run up, asset bubble run up here, especially in the US. But there's a lot of signals under that. I don't think that, if you want to go through anyone individually, but we look at things like the number of stocks hitting 52-week highs versus lows versus history. People are greedy, right? Global PMIs, you talked about, macro data. It's saying you should be more careful, because when you're under 50, 52 and the numbers going down, that's not a good sign of where the global economy is headed, right? The only thing that's really in your favor here for extreme fear is an inverted yield curve in the United States. But there's lots of different reasons why, kind of we go through the history of each of these signals, and there's education on it. But right now, this is when, you shouldn't have a complete long only portfolio without at least having some defensive positions, some risk management on your portfolio. So I'll leave it there, and we can go through either where we say like the playbook overall is for us, or if you have individual questions, I'd be really happy to walk through any of those, because I think through questions, that you have, that probably a lot of people have, you get to know us better, and also you get to see some of the data that we look at.
Fabulous. Nadine, thank you so much for that. I think that was a very good sort of top level overview for us to sort of think about how we are looking in the markets. But if I were to understand what this chart is saying, it says be very careful, right? So that's essentially what I think I'm reading here. Would that be a fair assessment to make?
Yes, like you shouldn't have a long equity portfolio with no risk management. That you need to be thinking about risk management and have a plan B and a plan C embedded in your portfolio, right? And taking advantage, which you should have done probably last week, of that low volatility that we were seeing. And we were, every day we come out with a video, and we've been talking about this with the VIX low and the volatility of volatility low. This is a great time to be putting, protection on your portfolio. So we do advise people when we see this, what to be doing. But even at this level of 75, I agree with you, Rajeev, is that this is something where you'd be, needing to risk manage your portfolio.
Yep. So if this is the position that sort of everybody seems to be in, right? So that's sort of, as you said, everybody sort of is in a risk averse kind of a mood right now. It's clearly risk off at this point in time.
But their portfolios aren't, Rajeev. Their portfolios are, and that's like the difference, right? Is like the sentiment is there, but a lot of people covered their shorts, so they haven't put their shorts back on.
I see. Okay, so they cover the shorts, they don't have the shorts back on. So they are exposed at this point in time, but it's still a dangerous zone out there. That's where we are at the moment, right? So what's the right thing to do here then? What would be, so you put the shorts back on, is that what you do? Or what exactly would one do with one's portfolio?
So I think it really, you first have to start with what are your objectives in terms of risk, return, liquidity. There's so many things that we walk through with people as we onboard them as potential clients. So that's number one. We go through a lot of different objective questions to say that, right? Because I shared before, we have some clients that ask us to run portfolios that cannot have any hedges. So, what do you do if you are in, and that category is I can do anything, right? There are fully hedged, do anything tactical portfolios. We have a lot of cash. It's invested. Like I put a bunch of trades on this morning and got 5.3+% returns on treasuries, for the short term. We can have some shorts outstanding and things that we think that have overrun. We've been long some volatility. When it was priced really cheap, and this is volatility on an interim basis. There's so many things you can do if you can go cross asset classes. So you can be doing short-term treasuries like 3 month. You can be holding, cash in a really high money market yielding vehicle that we have for our clients, backed by treasuries or backed by very, very secure institutions. You can be bringing down the risk in your portfolio if you have equities. So maybe you're looking to shift geographies. Maybe you're looking to shift to, more staples, more utilities, more healthcare, probably less, non-cash flow oriented tech. dialing back a little bit on the consumer discretionary and things that have run too far. There's so many different things you can do. So you really need to use all the tools in the playbook that you are given versus your objectives to say, what do you do, right? So we have to risk manage for, on the extreme end, institutions that don't allow us to use cash and only equities globally. So we play sectors, we play factors, we play geographies, currencies. And then the other end, do anything portfolios, which, if I can click, 5.3% for 3 months as part of my portfolio, like why wouldn't I do that? But keep things liquid so that, gosh, if there is a debt ceiling impasse and we get past the X date or even near the X date and there's a downgrade of the US, we're going to be picking up risk assets. We're going to be so excited. We started our firm in August 2011 with our hedge fund. That's what we started with. And it was a couple of days after, the US was downgraded. So we were able to pick up securities like an American Express at such a discount. So, we just stay very, very flexible for our clients. And that gets to the third part. Remember when I just said that we're very tactical? We use that ability to be tactical. So even if it's just shifting equities versus shifting across asset classes and hedges, we do what we can for the objectives of a client and their account, given this setup.
Got it. So if I were to read what you're saying, so you sort of wait for, the environment where the bottoming happens at some point in time. It's not quite the bottom, it sort of seems to be headed that way. Once the bottom happens, pick up a bunch of things and then wait for the reverse to sort of happen again, right? So sort of wait for the risk on process to sort of start happening. So that's sort of the thought process here, right? So what is it that would tell us that we are bottoming, Nadine? So, where would you sort of, the question is, it can always go down further, right? Where does it stop becoming catching a falling knife and starts to become something that seems to have a floor under it? What would you, how would you sort of ascertain that position?
Sure. And there's two parts to the answer. One is based on macroeconomic data. So given the cycle, where should the market bottom? And the other is, call it event risk. For example, the US not coming to an agreement on the debt ceiling, right? So let's take the answer in two parts. So if it's macroeconomic, you can still have, call it, low ISM, low PMIs, below 50. But if they're starting to improve a little bit, and what can improve them, maybe it's Japanese tool orders, or maybe there's other types of statistics you can look at to say things maybe look like they're going to not be so bad, right? So when things aren't so bad, you want to be starting to put in, you don't go fully in, but starting to put in positions. So that's macroeconomic data for you. So when we looked at around the world where we're headed, we're also looking at how long are these Ds? Is the deflationary environment, I don't know, just a quarter or two, or is it a whole year? So from a macro perspective, you need to be using the data and forecasting out to say, well, where is it headed? When could it turn? You're looking at a lot of the data underneath the summary data. And are there pockets you can go earlier? So for example, you could say in the fall, China EM came out of things earlier than the US. So there's certain things where you can kind of shift around your capital, but overall you want to be seeing things just kind of slowing their descent so that you're heading towards maybe an improvement. But it could still be bad numbers. You could still be slowing, with, under 50, but it's not as bad as before. So that's number one. But then number two, event risk, obviously that's not something that you can control. It's not something that you can identify for sure is going to happen. But as an investment manager or a person with a portfolio, you have to be thinking about, well, if these scenarios happen and what's the likelihood of that, what would be my game plan, right? And think through for every, position in portfolio, well, here is what I would do. So what gives me the optionality if that happens to make a little bit of money? And then what would I do in that case? And here's a real life example is for those portfolios that we can't have much cash above 5%, can't hedge, can't own bonds or anything. In February and March of 2020, we had a very risk-off portfolio for them. We were in Japanese drugstores and other things that we thought could, weather the storm of the pandemic, because we were worried about it in January of 2020. So what happened is we had a lot of gold positions, and they're not gold miners, but royalty gold positions like Franco-Nevada or other things. And so on a relative basis, because that's the game they're playing, gold did very well because everybody, rushed into gold during that time and they were so worried and the market was tanking. But then, we could use, the algorithms around Longbow to say, oh my gosh, gold's now overbought, right? Remember the dollar was overbought, gold was overbought. So you actually have to let go of those positions. So in that case, we got out of gold. And then someone asked, well, how did you know to own Canadian banks at that time, right? And so we could see that certain things like very good assets were way oversold because everyone was just looking for liquidity. That's your best case scenario in many ways if you're already protected and hedged, is that everybody throws everything out. They throw American Express out, they throw Canadian banks out, and then you go pick up those things, right? So you say goodbye to your defensive position or your hedges, and then you say hello to things that are oversold. And obviously that does take a process, that does take data. I understand it's experience, it's expensive to have that kind of data, but that's why we came out with Longbow, right? Is to provide tools backed by Bloomberg, an institutional Bloomberg license, and our algorithms to help the everyday person see the kinds of things that we're seeing. We produced free videos every single day in notes, kind of taking sense of the, hopefully in a humorous way, of some of the things that are going around the world so you can manage your portfolio a little bit better. We think it's been a huge mistake that technology has gotten people to trade more versus trade smarter, right? Do your homework, decide what you want to do, but then check the signals to say, well, where is everybody else at, right? And if you're going to be going towards the herd, probably not going to make much money and there's probably going to be more risk. So you want to be always staying away from what everyone else is doing because you might lose something, but it's not going to be a ton, right? Because nobody's over going where you're at. Nobody's betting, they aren't betting against you. So they're not going to make much money if they win because they're all together. So that's really the approach that we take and kind of answering your question. It depends on, the macro and the market, but then it also depends on, is there some event going on? How do you deal with that portfolio?
So the other question that generally comes about in these certain scenarios is, okay, so let's assume that we know exactly when the bottom is happening and we know that we need to pick up a bunch of stocks, right? But the problem is after that, the time scenario for when things start to move is also very fluid at this point in time. We could sort of end up with a long period of narrow trading ranges, going up and then coming down and sort of staying between a couple of moving averages and sort of, going sideways literally, right? Which sort of is, again, harmful for high beta stocks if you decide that we're going to take that, right? You would rather be in maybe value stocks at that point in time, very simply because of the dividend-laden nature of those kinds of stock. So how do you sort of know what to do in these, because the difficulty is in reaching a conviction on what is going to actually happen, right? If you're going to continue to go into a sideways trading range, then obviously it's better to continue to be in cash or whatever else that is better. How do you sort of make a call like that?
And the beauty of what we do is we always kind of know who we're playing against, right? Because you can kind of look at the, MSCI ACWI or whatever. So we know who the big caps are and who you're playing against, but you need to decide, well, who am I playing, right? It's not going to be maybe the tech company in China with a lot of regulatory risk that ran up, into January, February. Maybe it's the Nestle that's been taking price and is going to continue to take price and be chugging along. That's what you're doing. Or it might be, when EM was completely sold off, maybe picking your positions in India and Mexico, maybe Brazil and other places to say there's some positions here that are way oversold. So worst case scenario, they might bump along, but man, I might really get a re-rating if the dollar goes down. So you're really thinking through, again, those 8 to 15 themes and saying, well, who are my best players to play that? Right, given this macro scenario, and that's what we try to do. So you might put a little spice. I always say, if you can be tactical, you decide what percentage of your portfolio is what I call the sandbox, something you can play with that if you lost, you wouldn't care. So that might be 0 for some people, might be 10% for others, whatever that is. But you might put in spicier things like, oh, I always loved that tech company. It's trading down 50%, I want to put a little bit towards that. So it gets to overall exposure in that kind of bucket and also individual. That's when you really don't want concentrated bets, right? When things are much, much more risky from a fundamental or tactical or macro point of view. But you do want to know who your playbook is. You want to have a playbook to say, I know what REITs are going to continue to grow throughout a negative growth economy, because people are moving data to data centers, right? There might be one that you love, or which utility is transitioning to better returns because they have more, I don't know, wind and water and other kind of, generative assets, and they got really hurt when rates went up, and we think rates were going to go down, so you'll get a double benefit from it, right? So there's lots of different things, but you don't want to be making the same bet across your portfolio. That's really the mistake it is. It's like you don't want to buy like all the Canadian banks in my scenario, right? You don't want to be, buying only one gold company if you're going to gold. So you do need to think about individual security risk from a portfolio construction standpoint, but then have those I call them popcorn popping, where like the popcorn could be popping. So overall your portfolio is returning a better return, versus saying, I'm going to make that one big bet. Good luck if that's how you manage your portfolio, but that's not what our clients ask us to do. So we don't do that. We're not a venture group.
Okay, so let's sort of maybe move on to some of these event-based risks that we're talking about at this point in time, Nadine, and we are going to explore, perhaps starting with the debt ceiling debate, because obviously that's the one that's sort of hitting everybody at this point in time. What do you think so one is, where do you see the scenario? What's going to happen? And the second is really, what is the implication? What's the implication of the scenarios, unfurling on your portfolio? So if you could sort of combine both of those and give us a point of view.
Well, just look, they're meeting right now. So 3 minutes ago, they started meeting again, but there's a current impasse, right? And so nobody knows what's going to happen. We know that nobody wants to have a debt ceiling impasse, but let's take like the good scenarios that somehow they come up with kind of a solution today, but it doesn't hurt the economy, and they just decide to come together to do the right thing for the United States and the world. I don't think that's going to happen, but if it did, risk assets are going to just go up a ton, right? So in that kind of scenario, the long part of your book is going to do quite well. Actually, volatility might rise. So our volatility hedge might do well because it's going from negative to positive. And around the world, all of the risk assets will do well. The dollar actually might pull back a little bit. It's kind of unknown what the dollar would do. Rates will come down probably, right? Especially for near-term treasuries. And that will give fixed income a pop. High yield would do very well. In a short term, we're talking like a short term, what will happen to the portfolio. But then people will start to kind of pick apart, which is in the more likely scenario, if there were an agreement now, well, gosh, what are all the terms that people negotiated? And as you've probably seen in the headlines, a lot of things that are being negotiated could dampen growth, right? So if they're forcing cost reductions, maybe that money would have been spent to fuel consumer spend or other type of spend that keeps growth going. Because this is the year before an election year. Obviously, one side doesn't want the current side to be winning next year, and the current side wants to keep their position, so they don't want cuts. And so, but if there is an agreement where the things are going to slow growth, so you might see this big rise in assets, and then it comes down. And people are like, oh, well, maybe that's not such a good deal. We're glad that we didn't go through the X date, but this isn't a good deal on global growth. So you're going to see a little unwind of that, right? So that's, so you kind of need to, if you're getting the short-term benefit, take off maybe some of certain things or add more hedges or, to kind of balance out what just happened. But then on the negative scenario where they, get too close, like they did in 2011. So even if they come to an agreement, they waited too long. And there's a downgrade. I mean, that's a scenario where short-term, rates really pop here. And a lot of things are priced off of US rates. So you're going to see that going on around the world. Equity markets decline. In that case, our hedges obviously go wild. You make a lot of money on those. We have very short-term treasuries, so we would not be impacted much by the, in terms of like, we're holding them to maturity in 3-4 months. So those types of things don't matter to us because we're just going to click a coupon. So I don't really care where that's trades in the short term. We would be putting our, selling all of our money out of money markets. and then putting them into our favorite positions that we think are oversold. So you never know for sure what's going to be oversold to what degree in that kind of scenario, but you know that with rates popping, you might be actually be able to lock in some amazing short-term treasury yields. Like you might only get an hour to do that, but you might be able to lock in certain things. And then for cash, going into risk assets that you know over, call it the next year, can do well during a slow or negative growth market, because certain things will, very high quality companies usually get oversold, because one of the things people do is they just sell to get liquidity at that time. Right? They need liquidity when markets are tanking. They might have hedges out, they have to unwind some of their positions, whatever it is. So you should take advantage of, their positioning, their illiquidity, their decision, at that time. So you can't totally decide, but you need to have, again, that playbook of what you might want. So when the time comes, you're spending your time executing, you're not spending your time researching what business you want to own.
Got it. Got it. So let's move on to the next topic, Nadine. The topic has, I think you pointed out to the four phases that the economy could typically stay in, the Goldilocks, that the four quadrant thing you made. It seems to me that the market is sort of looking at either a recessionary environment, i.e. the deflation part, or it's the inflation part. So you said it's going to fluctuate. And I mean, I'm sort of looking at a lot of people talking about stagflation as well, right?
Yes.
First of all, I mean, is it likely, which one is likely to be a higher probability, if you have a point of view on that? That's the first question I have. And depending upon that, what would be the reaction of the market per se, right? In terms of what will happen, what kind of money is there right now, which would have to move sides when that actually happens, right? If you know what I mean, it's not what I would position as, that's clear from your, from your deck. What I want to understand is, where is the money now? And where will it have to move if what you're saying actually happens, right? So if you could sort of share some light on that.
So people took a lot of shorts off when the markets were going up because their hedges were running against them. So people aren't as hedged as they were before. So from a positioning standpoint, yes, do a lot of people like us maybe have cash on the sidelines or with short-term treasuries? Yes, they do. But they also took off their hedges. And so when people start to short, that puts additional like short-term pressure, right? So that's one thing. Number two, you're going to see this week, liquidity tends to dry a little bit here in the United States before a 3-day weekend. It's going to be Memorial Day here. So you have to be a little bit careful reading into the tea leaves this week. But institutions also are doing the rebalancing. So they're probably rebalancing away from equities, which outperform, and putting things into fixed income. But your question about the I and the D, so inflation is really stagflation, but going back to deflation, you're going to really have to thread the needle this year. That's the full stop answer to your question, is that we are in that inflationary environment, not because inflation growth is accelerating, it's just at a really high level that's sticky. And so it feels like inflation to people, right? And they're worried, the sentiment readings, and they're worried about the next year. And then therefore they spend as if they're worried. So it's kind of a self-fulfilling prophecy. So you probably have 1 to maybe 3, probably 1 to 2 quarters where it could be trading in this range, bonds and equities. And you're saying that bouncing around, right? So shorts aren't making that much, longs aren't making that much. What are you doing, right? So therefore we want yields. That's how we're playing it now. We just want like guaranteed yield on the very short term, and we have them, termed out so they don't all go due on one day. They mature a little bit here, a little bit there across these months. And some in, very short-term money market where you can get a really nice yield, so that if any of these event risks that happen, we can take advantage, right? So that's how we think about positioning right now, and in some defensive positions, and riskier positions that we like. So it's not just all defensive, there's risk on positions. But then as you get towards the end of the year, the credit cycle really hasn't happened yet. One of the things we've been writing, and what we call the longbow arrows, that's our notes that go out every day. They're like humorous little summaries of pretty serious things going around the world, but try to make it a little bit more digestible for people who aren't looking at this day to day, is that, there's more bankruptcies going on. High-yield spreads are not that wide. And so as companies have, slower growth and still high costs, they have less money to pay their debts. Costs for debt are high. They have less money to pay for their CapEx, their share repurchases, all of those things. And when debt has to get refinanced for these businesses that had too much debt, like we've seen here, right? You've seen massive financial institutions who are let going their real estate properties here in the US. That's a huge deal. And so there's a lot of, and these are across different industries. It's not just, their energy businesses or their office, buildings. This is across different sectors. You're starting to see bankruptcies, and that is a big deal. And so when you think about like, how do you play that, you kind of have to look at our playbook to say, well, you want to be, some of your portfolio should be positioned for that credit cycle, because you don't know if it's happening in November or December, is it 2024? And it also may depend on some of the event risk stuff, like just trying to look at this market from overnight and say, oh no, we're going to stimulate, right? There are event risks that could happen that could then make the markets rip. And so you just have to be a little bit careful, but have the long-term view to say, I got to navigate this kind of like middling situation. And the other answer to your question of why there's still risk here is that, people aren't really pricing in more rate hikes in the United States. They're pricing in a lot of not just pauses, but rate reductions. And if inflation is as high as, and it stays sticky, that's just not going to happen. And so it's kind of like they're already pricing in a Goldilocks scenario. And so that's not something that we want to be betting on. That's why, again, you need, in our mind, to have the hedges on. You need to be taking a little bit more care with your portfolio, because the Fed's already come out. They're not this year taking rates down. And if they did, things would be really, really bad. They'd be taking it down because something bad happened. And that means that all your assets are down, right? It's not in a vacuum. And so, you actually hope they don't reduce rates this year if you're a long investor, because it's not going to be a good scenario. You really would rather just see them pause and stay paused for a little while and let you know when they're going to be bringing them down. That's your Goldilocks scenario, because it's priced in. And so the asymmetry is to the outside, which is like, yes, they figure out a debt deal, but inflation's high, and then they hike it 2 more times. Like, that's not going to be good for tech or, bonds or any kind of duration. That's going to be a tough situation versus where people are at right now.
So it seems to me, if it's I or D, it's not going to be good for tech either ways, right? So, perhaps that's the question. One question that I had was really around this. There seems to be some kind of a consensus emerging across multiple pundits that it's all a liquidity show, right? So it's once liquidity increases. For instance, the banks crisis had the side effect of increasing the quantum of money flowing in because of the the Fed's sort of the policy that they put in place. Exactly, right? So now if liquidity rises, riskier assets rise, and liquidity falls, riskier assets fall, right? So that sort of seems to be a simple binary kind of a viewpoint, right? Obviously, what you seem to be saying is a little bit more, it's not as simple as that, it's a little bit more nuanced. Where do you stand on that argument versus this?
It is nuanced because there's event risk, right? Event risk can change everything. So it could be to the positive if China stimulates, that means liquidity into the system in a certain area. So you would be wanting to be invested in businesses that are going to benefit from that, right? Not just in China, but around the region, and some European businesses that would benefit from that. So, and who are they going to stimulate? It's the consumer, it's not construction. So, you'd be thinking through, well, who's going to benefit from that scenario? But then there's QT going on. So if there's continued tightening going on here in the United States, that's obviously a liquidity drain. And obviously the financial institutions, I can just tell you from personal data points around here in Silicon Valley, and I can tell you obviously from businesses that we watch in the public markets, it's tight and it's tightening. VCs are worried, private equity folks are worried, obviously real estate folks are really worried. And financial institutions still have a lot of loans on their books to these people that they haven't written down. And so that's not a June problem. That's probably a November problem. And so when we look at that, that's more tightening going on, right? And so when we're looking at is it tightening or not, it's not just what's the U.S. government doing, but it's the U.S. financial system, it's China. Obviously, the Bank of England is probably going to raise 2 more times, raise to 550. It's tightening around the world. So you need to be looking, well, which pockets might be loosening or staying loose, which ones are tightening, and then maybe shifting your bets a little bit.
Okay, so
It's not
you're
an
saying the
all
event is
approach. It's not an all approach. Yeah.
okay, you're saying that liquidity still matters, but the fact is liquidity is driven by events, and that's what you need to be watching. I think that makes a lot of sense, right? Now let's shift our attention to the dollar, right? So obviously in either I or D, dollar has got a chance to rip upwards, right? So that's something that's sort of likely to happen, and you said that in the beginning as well. The other part about the dollar is obviously that there's a lot of world forces that are sort of
Going down.
looking at dollars.
Yeah.
So we sit in India and we have started to buy our oil in rupees now from Russia, right? And that actually is means that that 150 billion odd that we needed in dollars earlier, we don't anymore need, and we can print our own money for that, right? So that changes the paradigm from both perspectives,
totally.
right? It makes a current account a lot more rosier thanks to the reserves that we have. At the same time, it reduces our dependence on the dollar, just like it's doing across the world. What do you see happening to the dollar? Obviously, in the short run, if these circumstances play out, it's going to be shoot up to the dollar. It's already at what is it, 103.9, right? Something like the 104 almost, right? So bounced up nicely from 100, right? So where do we? I'm talking the DXY, of course. Where do you see the dollar going?
So that's the problem, right? Is like this isn't the time on a short term to be making your big bet. Not the time. Because those event risks, if there's a default, it's just going up, right? Yen, dollar, how the moves are going to play out. Gold, that they're going to be strong. But I completely agree with you. There's way too many forces. And given the historical move, that the dollar will be depreciating over time for the intermediate term. And so you do want to be, long EM. You want to be, long gold or certain kinds of materials. You're going to be wanting to be playing that, whether it's just you can short the dollar. You could short the UUP, the security I showed you before. So, which is near overbought today, right? But the problem is you can lose a lot of money in the short term and then be trying to gain that back over the intermediate term. And so it's not the time to be putting that on. That's for that reason, right? You might want EM for other reasons, but that's not why you're going into it right now. Because if you're down 20 and trying to claw that back, that was a bad move. So what you want to be doing is in the situation that one of those negative events happens, it goes up. That's your time. There you go. That's your time to be, shorting the dollar, going long other things that are going to benefit. But I completely agree. So it's not just, you guys and Brazilians and everybody buying materials, in whether it's local or other currencies like the yuan, but it's also, allowing for cryptocurrencies or other types of things where there's going to be more trading with other stuff other than the dollar. Sorry. So does the dollar still matter? Will it still matter? Totally. But I completely agree with you that you want to be going long those trades on an intermediate and maybe even a long term. It could be 10 years, right? Given the forces. But you can't just put your trade away or your investment away and just walk away and say like, that's what's going to be happening, because there can be these massive short-term moves, and that's really where you made your money.
Great point. I think on the dollar itself, right? So one of the challenges that we are facing is basically that Russia seems to be accumulating more and more rupees, and they don't know what to do with it. So they're starting to say, hey, what do we do with all this money coming in, right? And it looks like they have to invest back in India. So it's a double benefit, right? So the money we print is in rupees, and it also comes back to us because it's investment sitting in the Indian economy again, which seems to be a bit of a benefit for us. So I think that sort of seems to be playing out. Let me go on to, you mentioned gold a few times, right? Gold has had a pretty decent run. It used to be jumped from all the way from 1600, 1620 to 2080 and tested the highs and came back a little, right? It's now at 1960 or something. Obviously, the central banks purchasing gold seems to have sort of been the single biggest driver here more than anything else, right? Of course, risk off also allows gold to sort of benefit a bit. But where do you see it? Looks like you're bullish gold. Would that be right?
Yes. When the dollar's down, gold goes up. So intermediate term, and then what happens in event crisis? Gold goes up. So you might have a win-win situation. And if I go look, I just put up the GLD on the dashboard. This is the gold ETF here in the US, and it's just a good proxy. On the short term, it's been a bit bearish, right? So we've seen a decline in gold. But as you pointed out, it's had a really nice run since the fall with other, international markets and the like, and tech. And so it's bullish medium term. Right now you have 2.1 to 1 odds of if you bought it. It's not, and it's got a beta though, pretty high beta, really low short interest. And so, when I'm looking at this, so I would like to have this bigger, but implied volatility, where we're at 8%. So that's okay. It's at a premium. People are paying a little bit for protection here, but we're getting really close to the low end of the trading range. The white, which is the security price, is the low end, near the low end versus the high end. So that's why you're getting, you have basically, in terms of percent from it, 3.3% upside to 1.6% downside on our trading range. This is short term. But when we think about like, why should it do well? Why should, this be okay? Is you have, when dollar goes down, gold goes up. So if you think intermediate term that's going to happen, you'd be buying it. Also, eventually growth will bottom and it'll go up, and metals tend to do well. Energy obviously does the best, other riskier assets. But we'd say that it's probably going to be used more as a better store of value, maybe versus the dollar. So it is something, in an event risk, you're probably going to get overbought. So that's when you have to, say goodbye to your position and trade out of it. But we think that it could have a continued run here.
But let me ask you a question.
Like really strong correlation. So in emergencies or urgent situations, I'm just trying to find a certain slide here. I'll find it. But basically, it tends to have a minus 0.9% correlation to negative correlation to the dollar, right? So when the dollar's up, gold's down, dollar down, gold up. So that can be, one of your plays of playing a lower dollar.
So the question is really that there is a reasonable possibility that the dollar shoots up thanks to the event risks that are coming up, right? And the short interest is also really low in gold at this point in time. It's 3%, as you pointed out, right? Which essentially means that if I were to use a contrarian philosophy, basically counter consensus kind of a point of view, you should not be long gold because obviously there is a possibility that could go up. How isn't that also a plausible scenario here?
Well, no, in events, then they move together. So they have a positive correlation in events. People buy again, dollar, gold. And then it's after that, then you get the negative correlation. So for events, so it might just be a win-win situation where you get the benefit, people are worried. But if there is, a debt ceiling negotiation, everything works out well, not going to pressure growth, gold will go down. That's what will happen. So again, you have to think about like, why are you entering it? We think of it, there's a really great, there's great research papers around why it should be, a certain position of your portfolio. And this is one of those times that it is better than not to have it. And so, when you look at the playbook, when does gold not do well? Gold does well in deflation. So gold does very, very well in deflationary markets. But it might be lagging, copper or other things in a Goldilocks scenario, but we're not calling for a Goldilocks scenario.
Got it. So last two questions. One is really China, right? So, you pointed out that China is still, obviously the reopening has become a complete damn squib at this point in time, and everybody's sort of, gotten off that trade, with perhaps licking their wounds and, the bruises that they've sustained here. Like, but still because of the fact that it's got such an outsized position to play the mainstream economy, it does hold quite a few cards. What do you think are the, the China scenarios that unfurl right now, and what happens to the asset classes if those scenarios play out?
Sure. So this is the opportunity and the problem, right? Is that it depends on a bunch of things, but you can't ignore China. So, if you're invested in the equity, China's huge. So, not just the U.S., but China, Japan, Germany. You could go pick your countries.
Anyway, they are our neighbors and they're belligerent as hell.
You cannot be ignoring. So when people are like, "Oh, I'm just not going to play," I don't think you cannot be thinking about it. I think you have to say, okay, if there's no stimulus from China, what happens? So the macro, I actually have a slide here. So did I put China in? I can show you China. Oh, I didn't put the individual one. So China itself, I'll just let you know, is in a deflationary environment till about the end of the year, and then it gets better to about a Goldilocks, right? And so you might have some prolonged pain. So you've already seen the negative trade, which is people got too excited. Uh-oh, it's not growing that much. They're not excited anymore. And so now asymmetry is actually to the better, I'd say, from a macroeconomic standpoint, but it's just going to take a while. So as long as your time horizon is long enough, it will improve, right? So that's number one. Number two, if like last night when the markets were down again, at some point, they don't like that. And they're going to say, okay, we're going to stimulate, right? And so if the government stimulates, all the assets are going to go up. So what do you do? Because then you have the third part, which is obviously the regulatory and headline war between the US and China over whether it's technology companies, you know, TikTok banned in Montana, like what's going on? It's like this constant barrage against certain businesses. And then on the flip side, like even the government against its own tech companies, right? Not wanting them to get too powerful. So understanding like, why is Alibaba spinning off its businesses, you know, all of those different things. So there's a lot of moving parts. And to your point, Rajeev, you need to know what you own. So you might be better off owning a staples company that only depends on people buying, you know, groceries at the grocery store. You may be better off owning, you know, healthcare companies that's based on people needing more healthcare. So maybe you don't want to play the most obvious bets out there because there's too many risks that are open the envelope that may or may not go your way. You still might want to play those if, you know, if the US didn't get its, you know, debt ceiling discussions in time and everything goes down, those might be some of the businesses you want to pick up. But in the absence of that, why don't you pick up some local businesses or businesses in Indonesia, India, Japan, South Korea that benefit from trade with China. So that's what we do. It could be a soy sauce manufacturer with just, you know, obviously there's COVID cases, so this isn't the time, but they're going to get really hard. Anybody that deals with the consumer might get hit hard. Maybe you're going to pick up a soy sauce business out of Japan, right? So just try to think through the less obvious played things that could still do well. And that's what, when we argue those 8 to 15, you know, themes, the popcorn popping. So I don't want just, you know, China tech that could be all good or all bad across all these things. I want to have the soy sauce out of Japan. I want to have cell towers in India. I want to have, you know, I want to have different things. That's what I want.
Got it. Got it. Well, Brookfield already thought about it, and there are quite a bunch
Yeah.
of cell towers from my erstwhile employer, right? Reliance,
Yes.
right? So,
yeah, and we own Brookfield, right? So, and we own Brookfield. Like, we're smart guys, right? So they're big, but you know, out of the relative things we can invest in, yeah, like so that's a perfect example. Then I want a Canadian business doing the right thing. So that's the type of stuff that we want to think through, not the most obvious, but the next few layers, and say, well, that's going to be a, you know, pretty good bet.
Fabulous, fabulous. We come to the last question, and generally in the US, there is this obsession around real estate, right? So it's in three phases. One is really, you know, the homes that people own.
Yeah.
Obviously, there's a huge obsession around that. There is also the MBSs that come out of it, which is obviously collateral that gets used everywhere. So there is that, you know, that overhang as well. And right now, we obviously have the third leg of that, which is basically the corporate commercial real estate, which sort of seems to be, you know, developing a lot of cracks in the concrete, so to speak. What's your thought process on where this entire caboodle is headed?
Well, that's probably its own hour conversation, but I think that overall, you want to be in real estate that is not too leveraged, it has fixed costs or a known ability to refinance at reasonable levels if possible. And yeah, isn't going to cause too much damage. So, you know, it could be cell towers, it could be data centers, it could be things like that. It could be healthcare oriented businesses around the world. That's what you want. But if rates go down, like some things that people are worried about are going to do well, right? Because it's going to take the pressure off. But we'd argue that there's a credit crunch here in the United States like happening and going to really hurt. The credit cycle is going to happen. And in that case, you want to be far away from it. So sometimes it's just not playing. So if you don't know the time frame of it or assets that you're worried about, just don't play them. You don't have to short them. You don't have to go long. But also recognize the second derivative. So who are the regional banks or who are the banks that own a lot of homes here in the United States that could have a problem that people aren't worried about? That's one thing, you know, that I would argue. Another thing is, you know, are high yield spreads high enough? right? And so what would happen if there's a lot more defaults, a lot more bankruptcies, people not being able to refinance? And, so we try to take those storylines and say, well, who benefits, who gets hurt? And is this something we really want to play? Right? Is this something that we want to play, or is there something easier? But I can tell you that people are very concerned. People who are like focused all of their lives in real estate are very concerned, right? And the work from home trend, which we didn't talk about, which is part of the problem, not just high rates and a slowing economy, is here to stay. And so a lot of businesses that, in the January and February of this year said, you have to come back to work at least 3 days a week. Now I've said, maybe not, maybe 1 to 2 days. And so I think the expectations around whether office, real estate in the cities are versus outside them, how people live, what is the real estate they want, what have they been paying for it, who owns that debt, how has it been packaged? There's so many different levels here that, your question asks about. In some cases, we just don't play. And we actually think, like, I don't know how many times, don't call me about your real estate fund. I'm not going into any illiquid real estate fund right now. Right. But in a year or 2 years, that might be the best time to go into somebody's real estate fund. Wait till they find all their problems and they get clocked for it, and then you go in. So the same type of, be on the opposite side of the trade. Way too much money was in this asset when rates were low, right? So everything looked great. Everyone said real estate's the best investment ever, 20+ returns. Annualized. Well, yeah, in a low rate environment that works, but when rates are high and they're going to probably stay high for a while, it doesn't work so well. And it takes time for those things to unfold, for people to try to do deals that don't work out. They kick the can down the road. So wait till the more ultimate pain comes in before you go big. Make the easy trade when you have capital to invest, not the hard trade when you don't understand, like, how far is that knife falling.
Perfect. And I think that was a great end to the conversation. Thank you so much, Nadine. I really appreciate it.
Thank you, Rajeev.
I look forward to further such conversations.